Major support for Carolina Business Review provided by Grant Thornton. Operating in more than 100 countries, our tax, audit, and advisory professionals specialize in helping companies unlock their growth potential. Colonial Life, providing benefits to employees to help them protect their family, their finances, and their futures. High Point University, the premier life skills university, focused on preparing students for the world as it is going to be. And Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services with more than 300 operations in 35 countries.
As we finally close out 2020 and look back on our tracks over this past year, what has been the most dominant feature besides COVID? How has it impacted our business? How about our lifestyles? I'm Chris William, and thank you again for supporting and watching the longest running and most widely watched source of Carolina business, policy, and public affairs. In a moment, we will panel our 4 resident economists in a 2-part program. Tonight, part 1 is a look back on 2020, and next week, part 2 is an economic forecast. But we will start this interesting discussion right now.
Gratefully acknowledging support by Martin Marietta, a leading provider of natural resource-based building materials, providing the foundation upon which our communities improve and grow. Blue Cross Blue Shield of South Carolina, an independent licensee of the Blue Cross and Blue Shield Association. Visit us at southcarolinablues.com. The Duke Endowment, a private foundation enriching communities in the Carolinas through higher education, healthcare, rural churches, and children's services. Barings, a leading global asset management firm dedicated to meeting the evolving investment and capital needs of its clients. Learn more at barings.com. On this edition of Carolina Business Review, an economic year in review featuring Sarah House of Wells Fargo Securities, Dr. John Connaughton of UNC Charlotte, Dr. Doug Woodward from the Darla Moore School of Business, University of South Carolina, and Dr. Frank Hefner from the College of Charleston.
Happy holidays. Welcome again to our program. One of our favorites of the year, not necessarily because it's good, although it is. It's more about the personalities. We're always glad to have these 4 exceptional economists. We like to think that they are our resident economists. Sarah, John, Doug, Frank, welcome to you all. Sarah, you're going to get the first pitch. And this is a review for all of you. So we went back 12 months ago and we looked at your comments about what you thought 2020 was going to be like. You ready? You guys ready? Okay, you all agreed on 3 things: that the Fed would be dominant in the economy, and pretty much it was. You also all agreed on the idea that presidential politics was going to more than take center stage, and it more than did. And then the third thing is, and you all agreed, and I stress that point, that you all thought for the balance, if not the whole year, that we would have, quote unquote, a good, healthy economy. Sarah, how did you guys miss that?
Yeah, us and everyone else, right? So I think what we saw with 2020 and the COVID crisis is this is going to be used as the example in textbooks for decades to come of what constitutes an external shock to the economy. So I think that's what it is. It's that external shock.
John, Frank, Doug?
Well, I think we've been pretty lucky in some extent because this was an external shock. It was not an organically driven issue. It was not a policy issue. So unlike some other recessions and problems that we've had that are driven by bad policy mistakes or just other inherent things to the structure of the economy, this is clearly external. It had nothing to do with the actual structure of the economy. So that, to me, it says that why we haven't had a complete and utter collapse in the economy, because the fundamental structure going into this was actually fairly healthy.
Yeah.
So that's the point I always look at.
If I could just add to what Frank said, even the epidemiologists, they're the ones that should have been predicting this, not the economists. They didn't see the health crisis coming that a few warned us about, Bill Gates and so forth, but obviously this is not something that's easily predictable. So as economists, we don't feel too bad. Sometimes forecast is Frank and Sarah were saying, we're always looking at the internal structure of the economy, and I stand by our forecast from last year, had it not been for the internal shock.
Mm-hmm. John, I want to ask you, following up on that, and you can answer that.
Yeah, that's pretty much it. No one saw this. I said nobody saw this coming, and this is one of those things. The last time this happened was 1918, 1919. It's 100 years ago. It's not baked into anything, but I want to highlight what Frank said, and I think this is really important because we've seen a tremendous recovery after the initial set of lockdowns were lifted in late May and June. And if you look at the unemployment rate and track just that unemployment rate, we had that 2-month spike, and then it's almost gone down almost as quickly as it went up. And so we're sitting with 6.7% unemployment rate in the US. In October, 6.3 in North Carolina. While that is not back where we were at 4% or a little bit below that, the one thing that's really important to understand is that it's a whole lot lower this far into recession, 9 months into a recession, than the rate which was still climbing in the 2008-9 recession.
John, you didn't mention South Carolina. We're 4.2%.
Exactly. So my point is that Frank's spot on when he says that the system, the financial system, the basic bones, if you will, of the economy are in good shape. Once the lockdown leaves, this is ancient history.
So I'd like to add something about the local economy. Here's something that we've been talking about. There's been so much going on. It's really hard to recollect what I said in January, February, because so much has happened that seems to take more precedent. But it wasn't that long ago in the year that we were talking locally, where are we going to find the workers to fill the jobs? And that was the hot issue in the Charleston metropolitan economy at the beginning of this year. And if there was an issue that we were concerned with, it was the supposed trade war. There was wreaking havoc on the supply chain network, which we're still recovering from, apparently, for a lot of reasons. But indeed, in this area, trying to find enough workers to staff the hospitality and tourism industry was really problematical, plus the construction industry.
Okay, and sorry, Frank, sorry to interrupt you. Sarah, I want to come to you though. But I mean, before we leave the technical analysis of the early part of this year, there was a market economist, or no, I'm sorry, a market analyst that said a couple things that stuck with me. The first thing was, he said in a call, and it was an internal call about markets and capital markets, et cetera. And he said, this was a man-made event. And then the other thing he said was we had technically we had the quickest, shortest bear market in US history. And that was a 2-week bear market because it dropped by more than 10% for a prolonged period of time, not the traditional measure. So when you look at this idea that this is an artificial man-made thing, it also infers that it can be corrected by us with levers. Would you buy that?
Well, I think to some extent every recession or downturn you could consider man-made, but I think in terms of the levers to get us out of this, I mean, you've seen monetary policy go full throttle, and so that's been a big story this past year in terms of just how quickly the Fed acted and how they really pulled out all the tools in their arsenal, which I think helps stabilize markets. And I think that speaks to Frank's point in how this is really not an economic crisis in the way the financial crisis was back in 2008, 2009, and that the fundamentals are a lot stronger, which bodes well for the eventual recovery, but we still have a ways to go. In terms of the policy response to, I think a big story this past year has just been the fiscal response. The fact that in April, when you had the biggest job losses on record, you also saw the biggest increase on record in terms of personal income. And so I think that's been a big part of why we are where we are today, with the labor market still having a long way to go, but recovered, I think, more than expected. And on balance, households' finances in better shape than I think what many people expected. Now we can get onto some of the nuances there and how it hasn't been even, but I think you have seen some pretty substantial policy response that has helped the overall situation from, I think, where a lot of people thought we would be right now in those March doomsday scenarios.
So when one of the things that I missed, I don't mind, saying I missed this forecast, which is at the start of all of this. Remember, we started the lockdown, certainly in the South Carolina economy for a brief period of time, was what would that do to personal consumption expenditures? And so the idea was, I looked at it and said, their municipal governments and state governments are going to be in deep trouble because they're not going to receive all these sales taxes. What I didn't forecast accurately, and you pointed it out briefly, was the fiscal policy response. And that was the transfer of funds to people who are losing their jobs. We didn't do that in the last major recession. That was a prop for the financial sector, not to the individual people who are losing jobs. This time, we're actually making transfer payments to people that were losing salaries. And as a result of that, personal consumption expenditures really did not take that big of a hit, apparently. So that was something that was completely unpredictable based on what the policy was going to be. And we're facing that right now also with the current debates on where we're going to go from here. So, but that's to be, we're going to have to speculate on that one.
If I could just add to what Frank said, what really surprised me about the policy response on the fiscal side was the consensus over government spending to the tune of the CARES Act and other programs of $3 trillion, way beyond anything we've ever done before. And that worked, with the direct payments. It restored balance sheets among consumers. They started spending again, and we got into this positive cycle. So fiscal policy apparently works, and there was agreement among Democrats and Republicans that was what was necessary.
Just a note of caution on that. The CARES, the 4 acts that were passed early on in this by Congress, $2.7 trillion in total. There's still almost 600 billion of that unspent. So only about 2.1 trillion went into it. And that's not uncomparable to what happened in 2008 when we passed one right after the other, the TARP and the stimulus package. That was about 1.6 trillion. So the number here is when you put the two together, the numbers here aren't that much different. It went in different places, Doug. I mean, that's the key point.
Well, it is larger. It came quicker, and it went directly into people's pockets with the stimulus check. That's what
was it. For all of you, was it an effective use? And this is going to sound insensitive, but the economic question is: was it an effective use of funds, of fiscal policy?
Absolutely.
Yeah, I'll take the. Go ahead, Doug.
I'm just saying we can see the response. Frank was talking about it before. I think it was very successful, at least in the short run. Economy back on track and got us down to, in South Carolina, an unemployment rate below 5%. I think that had to do with the fiscal policy. That's what worked.
I think if you had all the time in the world, it could have been designed a little bit better, but we did not have all the time in the world. So I think considering how quickly they got it out the door, I thought it was very effective. And we can see that now in the numbers with, again, just given the historic collapse in output, yet how quickly we've bounced back, if not fully, but well on our way.
John, were you going to say something?
Yeah, I was going to say that I agree with Sarah in the sense that it was not particularly well designed, but nobody had the time to really figure out where, when you're starting to lock things down, you really don't know what industries are going to be impacted most. And so there were a couple of innovative things that worked fairly well, but ran out of money pretty quickly. And that was payroll protection and loans to small business. The big thing with small business is that it was awkwardly implemented. And so the money didn't necessarily get out to the right people and didn't get out to them in time in terms of small businesses. But with that having been said, again, it was way too much money, but we really didn't have any choice in the matter. Going forward, we need to be very, very careful in the next round of stimulus, which I think we need another round of stimulus, but it needs to be much, much, much better targeted.
Let me come back to the dominant headlines, of course, focused on things like that where people gathered. Restaurants, hospitality, movie theaters, flying in airplanes, et cetera, et cetera. So when that dominates and when the negative, I'll call them negative headlines, when we get this sense that there is an evisceration of industry sectors going on, how do we know, Frank, let me start with you. I mean, you live in an area that's tourism heavy, Charleston, the low country. How do we know what is specific to an industry but won't have, and this is my term, won't have as broad implications to the economy, but certainly bad for one industry or two industries?
Well, for us, with tourism, the lockdown clearly had a major impact. And then it did not have as much of an impact on their manufacturing sector. So if you look at total employment in the low country in terms of manufacturing, it took a small hit, but on average, our manufacturing sector is doing all right. So the biggest problem is the hospitality and tourism sector. So the lockdown didn't do much for that, but now the fear of traveling and everything else that's going on is creating some other problems. So how do we recover from that? Well, it's when people feel comfortable traveling, making these decisions, and then spending their funds on that. I do believe there is a huge pent-up demand. And we see that as soon as they open up a restaurant in a community, they're generally packed, overpacked, unfortunately, in some cases. But there is a huge pent-up demand, and someone will come back. Now, on the other hand, there's always that other hand for an economist. We may have had an overbuilding on some of the hotels in some of the areas of the country when tourism was rip-snorting, going full steam ahead. So there may be some shakeouts in that area. Business travel is a huge component of the travel industry, and that, who knows, that's a good speculation on what that's going to do. Right now, business travel is down because so many people who can work remotely are working remotely. Unfortunately, people that are wait staff in restaurants and work in hotels, there is no remote for them. They have to be on site. So it isn't until on site is perfectly healthy and people feel comfortable that we're going to see a rebound in that area.
Mm-hmm.
I just want to add something to what Frank said about tourism and travel industry. We've heard a lot of people talk about the deep V recovery. And I mentioned earlier that from an unemployment standpoint, it's kind of the upside down V in terms of how quickly it went up and how quickly it's come down. But I think people need to be reminded that roughly in the US, we lost 22 million jobs between February and April. Half of those jobs were in the hospitality and leisure industry. They accounted for half of the job losses. Up to this point in October, November, most of the industries that lost jobs have roughly 90 to 95%, some 100% of the total jobs they had in February of 2020. Most sectors have pretty close to fully recovered. They figured ways of working around social distancing, getting people to their jobs either remotely or virtually or in a safe environment. The one industry that hasn't recovered is hospitality and leisure. They're still about 75, 77% of the job level they had in February. That's really where the problem is. And one more point on this. Mm-hmm. This doesn't show up in GDP because going into this recession, leisure and hospitality industry was only about 3% of GDP, but they account for almost 12% of employment. So, when you're looking at the GDP numbers, the economy can pretty much recover and still have this one industry in dire need, dire strait. And I don't see that changing anytime soon. I think we've gotten back about what we're going to get back for the short term.
Let me add just a couple of points about leisure and hospitality. In South Carolina, if it weren't for the losses in leisure and hospitality, we have an unemployment rate of about 2.2%. Every other sector, like John said, recovered. Manufacturing is back, distribution is back. So it is fine to leisure and hospitality when we got involved. But what I've seen in South Carolina, we are opening up again, and people are not social distancing, at least where I go. They're, took a little bit of a hit on the coastal tourism, but people are very quickly getting back out there. I see them in the restaurants, they're proud of it. And that's not true in other states. So what we find in South Carolina right now is, you look at the death rate from COVID. People don't talk about that a lot. We talk about cases, but in South Carolina, as we've opened up, we have about average across the country death rate right now. We've had, I think, something like 4,600 deaths in this year in COVID. North Carolina, maybe there hasn't been as much opening up, but they've done better. The death rate is lower. There's only, I think, 5,700 COVID-related deaths being reported right now in a population of over 10.4 million people.
Mm-hmm.
So North Carolina, from that point of view, is doing better than South Carolina. We're opening very quickly, but to some degree, you're paying more of a price, I think, as a result of that.
So the sectors that we clearly have seen that are doing exceptionally well, that everyone knows about, is try to buy something at Lowe's. That's impossible to do. Reconstruction and remodeling. I mean, the price of lumber, that's another one. It's mind-boggling to me. Why is the price of their customers? You ought to wait 2 years before you rebuild. You can't afford to rebuild this. So we've got that industry going gangbusters.
Where
the port has had excellent container. So we have a lot of indicators that say things are doing okay in the state.
But there's a big difference, I think, between what's going on in terms of the service sector, like leisure and hospitality, which is obviously borne the brunt of this, versus what we've seen consumer spending on, where they've been stuck at home, where companies have needed their workers to do meetings like this virtually. And so we've had this huge surge of goods spending, which has benefited manufacturing, has benefited the ports. But I think what we're seeing is there's still this longer term headwinds in terms of those service sectors until we have a vaccine that comes out and we can return to a more normal state of affairs without having to worry about COVID and the death rates that nobody seems to be talking about as much.
We've got 5 minutes left, and I do want to a couple of things I want to get in before the end of that, and that's social disparity, the tragic death of George Floyd, of course, and the tragedy around some of the economic disparities that go on. John, will economic disparity and the attention that it has garnered this year, will it get lost in the shuffle of a recovering economy, or has economic disparity and social issues reached a new awareness that will continue to develop?
I think it'll get lost after the election. I think that it was all part of leading up to the election in terms of one side trying to paint a picture that was sympathetic to one party and not sympathetic to the other. I think with the new administration coming in January, I suspect that this will start to become lower and lower in the totem pole, if you will, of things that are meaningful. I think I got a lot of play because of the video, without question, but also in terms of at the time. I mean, we were only 4 months into this thing, but people were incredibly frustrated and they were angry, and this gave them a voice.
Mm-hmm.
I think one area where it could, I'd say one area where it could continue to influence economic conditions is the focus that the Fed has put on employment, and over the past cycle seen the benefits of what we might have considered a hot economy but not causing inflation, yet the benefits that accrued to some of these groups who have been more marginalized and haven't had as much economic opportunity or success. I think you have seen a shift in the way the Fed views employment and views how they might actually be able to make a difference in that capacity that I think will carry forward for some time.
I just want to say, though, the Fed policy this year, expanding the balance sheet, pumping $4 trillion of liquidity into the economy, it's like it's creating more disparity, as we see the disconnect between Wall Street and Main Street. And on Main Street, who need jobs, especially those lower wage workers, are still suffering while Wall Street's booming. And I think that contrast, that's divergence, is going to be a big issue, because Fed policy is now helping the rich get richer. And the people who are out there protesting, these are not people who own stocks. They're not owning wealth, and they're going to fall further behind. I think this is going to be a significant issue in the future.
But that's what the Fed can do in the short term. And so they're doing all they can, but they've also been emphasizing the need for fiscal policy, because in some ways the Fed can help, the better offs through the asset markets, but it's really fiscal that helps folks at the lower end. So
well, that's what they talk about, but that's not the reality. The reality is that you see it in the stock market, the rich are getting richer and wealthier, and the poor are getting left behind.
I would love to unpack that more, Doug. That obviously is a critical dialogue, as John said earlier, is probably going to get lost in the dialogue. We've got about 2 minutes left, and I want to go around the horn a little bit. Frank, we'll start with you. What do you think will be, knowing what we know right now, knowing what we've just talked about, and looking forward, what do you think the dominant dynamic of the economy will be in 2021?
Oh my gosh, this is impossible to forecast.
Got 30
but I think it's going to be predominantly some of the structural changes that we're going to see in the way businesses operate. I think that's going to be a big one. So I'll just leave it at that for now.
Okay.
All right, John, what do you think?
Well, I think that what we're going to see in 2021 is we're going to learn a lot about how consumers appreciate risk as we start to see the disease go down, but also as we start to see vaccines come online. But how quickly are consumers going to be willing to get involved in situations without social distancing with people they don't know at restaurants, conventions, in the mall, etc.
Okay.
This is going to be very interesting sociology going forward.
Yeah, I just say I think it's going to be
Doug,
all
quickly,
about the vaccine.
yeah, tell me what you think, quickly.
Just all about the vaccine. If the vaccine works and people normal, no more suppression of the economy, that's going to be the big story. We're assuming it. Now we'll see.
Okay, Sarah, you've got about 15 seconds.
I think with piggybacking off of Doug's and the vaccine effectiveness and people's willingness to take it, I think a big story will be how much do services come back, and are people set on all those things for their houses? They've got their own cars. So do we see that shift back towards services? We think we will.
Sarah, thank you. Sorry to cut you off. Thank you all. Join us next week for our forecast of 2021. Happy holidays. Until next week, I'm Chris. Good night.
Major funding for Carolina Business Review provided by High Point University, Martin Marietta, Colonial Life, the Duke Endowment, Barings, Grant Thornton, Sunoco, Blue Cross Blue Shield of South Carolina, and by viewers like you. Thank you.